In this video, I'm going to discuss the types of long-term bonds and some of the most popular characteristics that come with them. First, I'll introduce long-term government debt and municipal bonds. Then I'll switch gears and talk about corporate debt and foreign debt. Then finally, I'll introduce bond ratings and why they're used. There's a wide variety of long-term debt issuances. Government debt refers to the debt of the U.S. federal government and federal agencies. Municipal debt refers to the debt of state and local governments. Corporate debt refers to the debt issuances of private companies. Mortgage-backed securities, or MBSs, are securities that are backed by bundles of mortgages that are very similar. Finally, international bonds are sometimes lumped together in a specific bond class. Let's start with long-term federal government securities. In the last video, I discussed T-bills. Those are the short-term debt issuances of the U.S. federal government. Treasury notes are the medium-term issuances of the U.S. federal government. These are bonds that are issued with a maturity of greater than a year, but no more than 10 years. Any bond issuance of the U.S. federal government with a maturity of more than 10 years is a Treasury bond. Note that unlike T-bills, T-notes and T-bonds offer semi-annual coupons to investors. Next, we have municipal government bonds. Municipal bonds are debt issuances of state and local governments. Municipal bonds can offer investors higher rates of return than U.S. federal bonds. They're used to raise cash to fund state and local budget shortfalls. They can also be used to raise money for a specific project, like a new road or a new school building. Let's take a look at one of these municipal bonds. The municipal bond I chose is a municipal bond that's issued or that was issued in my hometown of Terre Haute, Indiana. You can see that it's maturing in July of 2027. It has a coupon payment, or a coupon rate I should say, of 4.6%. Its price, so present value right now, is 100.102. It's probably got a face value of 100. And its yield, which would be its yield to maturity, would be 3.854%. And usually with these bonds, you can see that there really are not that many trades occurring with regard to these bonds. So these are the most recent trades associated with this bond, and the last one occurred in 2014. So that's that. Now there's one final point that's extremely important for municipal bonds. Interest paid on municipal bonds is tax exempt. This is a big benefit for investors. As an investor, if you're considering whether to invest in two bonds, one corporate and one municipal, the tax exempt status of the municipal bond will increase the after-tax yield to maturity. So there's an advantage to you as an investor if you're considering a municipal bond and you just happen to be in a high tax bracket. The formula we use to determine the after-tax yield to maturity for corporate bonds is provided here. We multiply the pre-tax yield by 1 minus the investor's marginal tax rate. The marginal tax rate is the rate in an investor's top tax bracket. We use this number because if an investor is considering buying a bond, that bond will provide some interest income to their taxable income on top of what they're already earning. The big difference between this formula and the formula we use for municipal bonds is that the pre-tax yield and the after-tax yield for municipal bonds is the exact same. Let's look at an example. Let's say you're considering buying two bonds and you can only invest in one. The corporate bond has a yield to maturity of 10% and the municipal bond has a yield of 7%. Everything else about these two securities is similar. Your marginal tax rate is 30%. Which of these securities should you prefer as an investor? To answer this question, we need to calculate the after-tax yield of each bond based upon the pre-tax yield and your marginal tax rate. Notice that municipal bonds are not subject to taxes, so your pre-tax yield is equal to your after-tax yield. In this case, this means that your pre-tax yield was 7% on the municipal bond, and that means that your after-tax yield is also 7%. The after-tax yield on the corporate bond is 10% times the quantity of 1 minus the marginal tax rate, which gives us 7%. In this example, investors with a 30% marginal tax rate should be indifferent between these two bonds. Why? Because the yield to maturity, or rather the after-tax yield to maturity, is the same. Let's try another example. In this example, we have two different bonds, one corporate, one municipal. The corporate bond has an 8% pre-tax yield to maturity. To calculate the after-tax yield to maturity on this bond, we multiply the pre-tax yield by 1 minus the marginal tax rate. Once we've done this, what we can see is that the after-tax yield on the corporate bond is 0.056 or 5.6%. Now, because 5.6% is obviously less than 6%, assuming everything else is equal, including the time to maturity and the other characteristics of both these bonds, in this case, we would want to invest in the municipal bond rather than the corporate bond because it offers us, as investors, a higher interest rate. Now it's time to talk about corporate bonds. Corporate bonds are used to raise cash for capital budgeting projects, buy inputs for the company's inventory, and several other things. When a firm issues a new bond, it drafts what's called a bond indenture agreement. That agreement details any restrictions, called covenants, the firm's creditors place on the firm before they'll lend to the firm. The indenture also details the bond's coupon rate, its yield, its face value, and its time to maturity. It will also identify exactly how many bonds are being issued with that particular issuance. It'll detail whether the bond is secured by any assets in the case that the firm misses a coupon payment, and finally, it'll detail any additional characteristics associated with the bond. For an example of this, the link that you can see here right now, this is an example of one of Apple's corporate bonds. Now let's dive into bond covenants. There are two kinds of bond covenants. Both are statements in the indenture agreement. Positive covenants are covenants that state the firm will do something good, like maintain a cash ratio or a quick ratio above a certain value. Negative bond covenants are covenants that restrict the firm from certain actions, like issuing new bonds or issuing a dividend to shareholders for the first time while our bond is still maturing. Covenants are most commonly associated with firms that are risky. These firms are usually unprofitable or have variable cash flows or are in the tech sector. Covenants are often used by bond investors to ensure that this firm will not take any actions that make its bonds more risky. Now let's talk about secured and unsecured bonds. Secured bonds are bonds that are backed by some asset or revenue stream. In case the firm defaults on a coupon payment or the face value of the bond, secured bondholders are entitled to certain assets noted in the indenture agreement. Typically, secured bonds have lower yields than unsecured bonds, since there's less risk for the bondholders in the case of default. Now let's talk about some other definitions associated with firm default. Let's start with senior bonds. Senior bonds are bonds that put the bondholder first in line after the secured bondholders in the case of firm default, and these bondholders that own these senior bonds are typically going to be paid something very close to what they're owed. Junior bonds are bonds with a lower claim on unsecured assets than senior bonds. In other words, if the firm defaults on what it owes to its bondholders, the secured bondholders are going to get paid what they're owed or what's listed in their bond indenture agreement. Then the senior bondholders will get paid, and then the junior bondholders will get what's left. And then usually the stockholders get the remainder, which is why we sometimes say that they are entitled to a residual value of the firm. Next, we have debentures, or debentures, depending on who you ask. Debentures are unsecured long-term bonds issued by firms. Subordinated debentures are unsecured bonds that rank below other debentures and senior bonds in the bankruptcy hierarchy. Finally, we have notes. And notes are unsecured bonds with a medium time to maturity. That's usually 1 to 10 years. Now, I do have some additional types of bonds and characteristics to discuss. First, we have income bonds. Income bonds are bonds that only pay coupon payments when the firm that issued them has enough income to make the coupon payment. Because the firm doesn't need to make a coupon payment in every period, these bonds are less risky for the firm to issue. Putable bonds are bonds that give the creditor, the lender, the option to convert them to cash at some period prior to the maturity date. A put option on a bond is a good thing for a creditor since it allows the bondholder to cash out of its bond position quickly and reduces the possibility that the bondholder will lose the face value of their investment. Indexed bonds are bonds that have a coupon payment that's based on the inflation rate. If the inflation rate increases, the coupon payment that the firm makes to its creditors is going to increase. Finally, we have junk bonds. Junk bonds are bonds that are more likely to be defaulted on than other bonds. We also call these bonds high-yield bonds or non-investment grade bonds, and we're going to determine exactly what defines a junk bond in a few seconds. But before we get to that, let's talk about a call provision. Most corporate bonds come with a call provision. A call provision is a provision that gives the firm the ability to pay off the bond early at a certain price, called a call price. Call provisions are popular for firms because firm management wants to be able to ensure that they're paying the lowest interest rate they can. If a firm issues a bond at an interest rate and then interest rates fall, this means that the firm will be stuck paying the higher interest rate. If a firm can call its bond and issue new bonds with the lower interest rate, then it can avoid unnecessary costs. The final two definitions we have for domestic corporate bonds are sinking fund and conversion feature. Some bonds come with a provision that require the firm to set aside a portion of the face value each year to ensure that it can pay back the entirety of the face value at maturity. For example, if the firm issues $100 million worth of bonds with a sinking fund provision, it might be obligated to set aside $10 million in an account each year until the bond matures in 10 years. At that point, the firm uses the $100 million it has in the account to make the face value payment. A conversion feature is a feature that comes with some particular bonds called convertible bonds. Convertible bonds give the bondholder the right, but not the responsibility, to convert the bond to a specific number of shares of stock prior to the bond's maturity. This is beneficial for the bondholders if the firm's stock price appreciates. Now, typically, the number of shares that each bond can be converted to is going to be specified in the bond indenture agreement. So, for example, you might be able to convert one bond to 20 shares of a company's stock, and you'll generally have a specific time period at which you can convert these bonds. Now let's discuss foreign debt issuances. Eurodebt is debt that's sold in a country other than the one in whose currency it's denominated. For example, if Tesla issues a bond in the UK and makes the coupon payments and face value payments in US dollars, that would be an example of Eurodebt. We also have foreign debt issuances like Yankee bonds and Samurai bonds. Yankee bonds are bonds issued by foreign companies in the United States. Samurai bonds are bonds issued by companies headquartered in the US, the UK, or other countries in Japan. The company makes the coupon and the face value payments in yen rather than the currency of the firm's headquartered country. Now, let's talk about one of my favorite topics, and one of the primary ways that investors know the risk of a bond: bond ratings. Bond ratings are ratings that are provided by private, outside companies that indicate the bankruptcy risk of a bond issuance. When a firm or country wants to issue a new bond, it will generally hire a bond rating agency like Standard & Poor's, Moody's, or Fitch to examine the firm's operations, their financial statements, and any other valuable piece of information the agency can find. The agency will rate the bonds on a scale. Letters closer to the top of the alphabet indicate a bond is less likely to be defaulted upon. You might be wondering why a firm or government would pay a rating agency to provide a rating that might be low. The reason is that bond ratings send signals to investors about the bond quality. Many investors don't have the time to analyze each potential bond that they're going to be considering investing in. So what they often do is look to low-cost heuristics like bond ratings. Bond ratings help reduce the uncertainty and information asymmetry between the borrower and its creditors. As a result, investors are likely to charge the firm or government issuing the bond a lower interest rate before they'll lend that institution money. Let's talk about the specific bond ratings that we have. Each bond rating agency has a different system, but the three largest bond rating agencies, Standard & Poor's, Moody's, and Fitch, use a fairly simple scale. A rating of A or higher indicates that the firm is very unlikely to default on its debt. A medium grade of BBB indicates that the bond is still unlikely to be defaulted on. Typically, we say that any B rating is considered medium grade. So BBB, BBB plus, BBB minus. The issue is that once you get below BBB, say to BB, you're technically investing in non-investment grade bonds, otherwise known as junk bonds. Remember, I mentioned those a few moments ago. These bonds are more risky. Finally, bonds with a C or possibly even a D credit rating are considered to be either very close to default or have already been defaulted upon. Let's take a look at some possibilities here. So here's a list of the Standard & Poor's and the Moody's ratings, and we have some corresponding yields and the meaning of each of these ratings. Bonds that are AAA rated have the lowest yield to maturity. AAA is our highest bond rating or credit rating. So for example, the US T-bills that are currently outstanding have a AAA credit rating. BBB rated bonds have higher yields. Why? Because they're seen by investors as more risky. They're more likely to be defaulted upon. So you can see that the yield for our BBB rated bonds is slightly higher than our AAA rated bonds. Now that black line that I have there indicates the line between investment grade, which is what those green bonds are, and non-investment grade bonds or junk bonds. Notice that the yield to maturity jumps up tremendously once we fall below BBB. Now, one important fact that I should note is that most institutional investors, like banks or mutual funds, are not allowed to invest in these junk bonds, these bonds below this black line. So the lack of demand for these bonds drives up the interest rate. And once we get into the C and D ratings, the yield usually jumps up well beyond 10%. In some cases, it could be 20% or higher. All right, let's summarize what we covered. I know I used a large number of terms, but they're all fairly commonly used in the industry. There are a variety of provisions and covenants that can affect the price of a bond. All of these are going to be listed in the bond indenture agreement. Bonds are also referred to by their place in the bankruptcy hierarchy. Finally, borrowers hire bond rating agencies to rate their bonds and signal the probability of default. This reduces the information asymmetry between the borrower and its potential lenders. In the next section, we'll be working on pricing bonds and calculating the yields most commonly associated with bonds. Thank you.